So welcome today, everybody, to our Managing Mito webinar. It's about financial guidance for chronic illness. Just first, I'd like to begin by acknowledging the traditional owners of the land on which I'm joining this event today. I pay my respects to elders past and present, and I would also like to acknowledge the traditional owners of the various lands on which you are all located today, and the Aboriginal and Torres Strait Islander people participating in this event. Mito Foundation acknowledges people with lived experience and living experience of Mito and those who love and care for them. Each person's journey is unique and a valued contribution to our commitment to end the suffering from Mito. We respect and value the generous contributions which assist us continually shape the work we do. Good morning or afternoon, everyone, depending on where you're joining us from. I'm Laura and I'll be your facilitator for today's event. I work within the support services team at Mito Foundation, and my role is to guide us through the session today. I'm excited to be here with you all, especially because I know the reality of living with Mito and how having a chronic illness is a significant financial burden now and for future financial planning. Please feel free to ask questions through the Q&A function, which will be monitored by my colleague Curly, who also works in the support services team. At the end of the pre-submitted questions, we will do our best to answer as many additional questions as possible. On this slide, we're highlighting some of the key financial and healthcare challenges that many individuals face when managing a chronic illness. These include everything from medical costs and medications to the broader impact of employment and daily life. The word bubble illustrates the various pressures that can accumulate, emphasising the importance of understanding what financial options may be available to help when living with chronic illness. So first, I just want to put a little disclaimer. It is important to highlight that the information in this session is general only. It is not personalised financial advice, and we will not be answering personalised questions during today's event. The following disclaimers are for Viridian, and they are, if you can read them. Otherwise, there will be a recording and we can make them available after the event as well. So today's guest speaker is Calum Liang. Calum is from Viridian Advisory and holds a graduate diploma in financial planning, fellow chartered financial planner, and is a member of the Financial Advice Association Australia. A lot of financials in that sentence. He has over 25 years in financial planning across both boutique and corporate advisory sectors. Calum excels at simplifying complex strategies for his clients. He and his team focus on building a financial independence, offering personalised advice with a professional yet approachable style. Calum is particularly skilled in helping clients approaching retirement to create and maintain their ideal lifestyle throughout strategic planning and regular reviews. Outside of work, Calum is actively involved in community initiatives, especially with Vinnie's Passages programme for homeless youth. A little about Viridian. Viridian Financial Group is a leading Australian diversified financial services business established in 2015 and has services across Australia. You can see the states on screen where Viridian is located. And Viridian provides financial advice that empowers Australians to live the life they choose. The financial advice business of Viridian Financial Group is focused on ensuring the power of financial advice has a positive and significant impact on the financial security of Australians. Viridian can work with you to develop and execute financial strategies for all stages of life. This includes wealth and retirement planning, superannuation, self-managed super funds, cash flow, insurance, Centrelink, aged care and estate planning. Calum, welcome and thank you for joining us today.
It's a pleasure and looking forward to the open conversation that we're going to have this morning.
The first question we have, Calum, is how important is it to start and maintain financial planning when living with chronic illness?
That's a great starting question. I guess what you're trying to achieve is trying to de-stress the financial surroundings, and if you have early intervention with your financial affairs to know things are in order, that's just one less thing that you need to focus on. a lot of people start to, I guess, get information from mum and dad around certain financial aspects. A number of people start different jobs and have different superannuations. But in general, if the more knowledge that you gain at a younger age and the more benefits that you'll gain as to understanding what you can and can't do with superannuation, home loans, etc. So the earlier that you start, certainly the better it is to remove some of that financial stress.
So, what types of insurance should somebody with chronic illness explore to ensure coverage?
This is a really challenging question. I guess some of the language that I'll use is probably going to just be straight insurance jargon, but I'll try and keep it quite simple. In Australia, we have superannuation, which is really designed for our retirement, but 9 times out of 10 inside a superannuation fund, you're highly likely to have some death cover and most likely to have total and permanent disablement. So death cover, as the name suggests, if you pass away, that sum of money will be paid out. It will be generally the amount of the value of your superannuation plus the death cover. And in some cases, if you are totally and permanently disabled, you'll have access to your superannuation and the total and permanent disablement as well could be paid out. That's generally designed inside superannuation. And if you have an employer fund, or even if you've set one up yourself through an industry fund, it's highly likely that you've got some of that cover. The other 2 insurances that you need to also just be aware of or consider is a trauma policy. So that would cover things like if you had an accident, illness, or a sickness of some sort, you are likely to recover from that, and that trauma policy would then pay out a one-off lump sum. It might be that you've put in place cover for 50,000, 100,000, whatever the number is, and that would be paid out at that point of time. Income protection or salary continuance, again, sometimes it may be through your employer if you're working for a big employer or you've taken it out early in life, or it may even be part of your superannuation offering. So as the name suggests, income protection covers your income in the event that you aren't able to perform in your current role. So that sort of policy is really good to have because you might use up your sick leave, holiday leave, or you have a waiting period, 30 days. And then after that 30 days, if you're still not able to return to work, that's when the benefit would start to pay you. And that benefit is normally linked to your salary or the value that you've taken out. And it could be through to age 65 if you're really not able to return to work. So that's more sort of chronic fatigue, stress, depression, and other sort of major accidents and illnesses as well. So that's generally the personal insurance cover that we would be talking about. Yeah. It's also important to probably comment just at this early stage that don't just think of it as your cover. It might be that you have a significant other that really needs to be involved, and it may be that they need some cover in place as well in order to cover off on the sort of broader financial affairs between the sort of household or who's under the roof. Yeah.
I guess that's really important to know. I had a question about the income protection, and you mentioned that it can pay out after 30 days. Is there different level durations of cover, and can you alter that within certain policies to reduce or make it longer? Or
yeah, good question. So income protection, 30 days is pretty normal as a waiting period. So let's say you have an accident, illness, or a sickness, and it's today, and you're not likely to recover. Generally, you might use up some sick leave or holiday leave, or you have to sort of wait the 30 days, and that waiting period kicks in. That waiting period can be extended, and obviously the longer that you can postpone the waiting period, the cheaper the policy is. So it might be that you push it out for 3 months if you've got a lot of long service leave, or if you've got money yourself. It might be that you push it out for 2 years because you might have some policy that is inside superannuation that will cover you for 2 years. So therefore you don't need any policy overlap. So you might have a second policy that kicks in after that. So that's the sort of the waiting period. The duration period, you could say, look, I want a policy to cover me for 5 years, and that would be sufficient if you felt that that would be enough. Or I want to make sure I'm covered, and that policy needs to cover me through to age 65. Yeah.
Perfect. Just on the trauma insurance, what happens if I get, sorry, I guess with Mito, it's something that individuals could explore with somebody as in a personal financial advisory situation. If I was to get a payout for Mito, say, and then I became unwell later on, would the insurance pay out, or is it just a one payment and then it ends?
That's a great question, because it really is policy by policy. So a bit like car insurance, you might have one window available for you, one windscreen available in your policy. Other policies might have unlimited windscreen replacement. So trauma policy is very similar. It may be that you've had a trauma reinstatement piece. So what that means is that you've claimed on one, it's then reinstated. You obviously can't claim on the previous, but if you then have a subsequent injury or accident, you could then claim a second time, and that's just one of these features and benefits of making sure that you have the right policy at the very beginning. Yeah, good question. So yeah, so that's the trauma policy, and I guess that's when you sort of have to go through the process to tick various boxes to have either a more comprehensive policy or a more simpler policy around reinstatement and other features and benefits, similar to other insurances on your house, on your car, where you choose to have different parts, and therefore that has a premium discount or a premium cost to all of those other extras. Yeah.
So we had a question from the chat. So they wanted to know, does death cover usually have an age limit?
They used to have an age limit, and it was 99 years of age. I don't know why that number was put in place, but you can apply for it mostly at any age, because nowadays people in their 50s and 60s may still require some life insurance because they've still got some debt, and obviously that might be used then for clearing off their debt, or they didn't want to leave the family in a vulnerable position if that person was to pass away. So you would have any age really that you can apply for death cover because of that. Some policies are a little bit more difficult to get. Other policies, you might just get it automatically in your superannuation.
Was there anything to add around insurances, or are you happy we move on?
It was more of a case of just don't think just of yourself. It may be that there's other significant others that need to have some cover, because it may be that it's a more significant event if someone else also has an accident, injury, or sickness, and therefore it has a sort of multiplying effect within the broader group of that family relationship, let's say. So yeah, don't just think of, take your blinkers off.
Yeah, perfect. And I guess it's important for somebody like myself living with mitochondrial disease that my significant other, I have the cover and my significant other has the cover to protect us both, because if I have a loss of income, then we are used to income. So yeah, it's really important. Thank you.
Yeah.
So is early access to superannuation beneficial for covering medical costs, and what are the long-term impacts for an individual? That's
a good question as well. So superannuation, you can actually access your superannuation early, but under fairly strict guidelines. Generally, and I'll give an example, through COVID, there was a lot of people able to access their superannuation because of financial stress or hardship. That generally had a cap of about $10,000. So even though you might have had hundreds of thousands in the super fund, you were limited to $10,000 under severe financial hardship. You can also access superannuation under compassionate grounds, and this is, I guess, where the medical costs, or there needs to be a why behind the ATO agreeing to release money out of your superannuation. So that the story would be that you have financial hardship, or you have significant medical costs, or you have life-preventing medical costs For example, people who are applying for a bariatric band surgery, who are obviously threatened by the obesity that they're in. That's a condition of release, because obviously that's life-threatening and that would shorten their life, and therefore the superannuation or the ATO would actually agree to pay that out. So early release of superannuation. On the flip side, obviously, if you're taking money out, you've got less at the end of the day. So, you know, it may be more beneficial for you to access your superannuation early, because you won't be needing it in 30 years' time, but the impact might be that you play catch up later, but the money is really required now for quality of life and so on and so forth. The Australian the ATO has a very, very good website, very simple, very clear. And I was just Googling it this morning, and really support additional reading and learning as to how you can access your superannuation. And it was really quite simple and very informative. So the ATO website for superannuation is actually good.
Okay, we can provide that link as well after the event.
Yes.
I can't think of anything else to ask on that topic, so I'll move on to the next. And we do have another question about types of insurance, but we can come back to that at the end.
Probably just to cover off on the superannuation access, it's really important that a lot of clients that I've come across who have had a significant event, the first thing that they do is just grab all their superannuations and put it into one, just to make things simple. But they might have chosen the wrong one to put it into, and by rolling old superannuations in, they've automatically just cancelled a whole heap of insurance that they thought they might not have needed, or it may be cover that they weren't aware of, and therefore we could have actually claimed, or it could be cover that is critical to, you know, some future medical needs. So it's really, really important when you've worked for a retail store and you've got Rest, and then you've gone to the building construction industry and you've got Cbus, and you've worked somewhere else and you've got all these supers. In actual fact, that could be the best thing since sliced bread, because in amongst all of those, you could have all these other benefits which you may not be able to be entitled to get now. So that's really critical to make sure you don't make a catastrophic financial decision, because that could cost you, you know, hundreds of thousands of dollars if you cancel those insurance policies to try and make your life financially simpler.
Yeah, that's a really good point. And if so say if I had a policy from an employer 20 years ago and it's laid dormant, would that still be, like, the insurance would still be open there, or is that something that would lapse over time?
A great question. So the insurances would still be inside that policy if there was still premiums and money still to be paying for it. So let's say you had $10,000 and every year the insurances are costing you $300. So you'd hope that the investment would be more to pay for the insurance, or it may just be whittling it away. And therefore, the best place to look at is your member statement that would come to you about this time every year after the end of financial year to say, this is your superannuation. I guess what most people do is sort of stick it into the top drawer, but I'm suggesting to take it out of the top drawer and let's have a deeper look at it. So that's a really quick one. There was a ruling that came in that if superannuation balances fell below a certain level, that the insurances may come into question, because obviously that's just going to start to erode the superannuation balance for retirement. But generally that member would be notified if they are likely to be losing that cover. Yeah.
And with each insurance policy that you have within super, I mean, I myself, without getting financial advice, I would not know how many different policies and supers I have. It's definitely not something that I'm knowledgeable in. Do those insurance policies require a medical, or do you not need a medical for those policies?
So a lot of those policies would have been what they call as an automatic acceptance. So if you've worked for a large corporation and you joined the superannuation fund of that corporation, they would have just automatically potentially given you some life insurance, TPD, maybe some income protection, because when they've got 1,000 employees, they'll assume that of that 1,000, 1 or 2 may go to claim, but we'll just accept that particular risk. So that's what we call as an automatic acceptance. So that would be potentially in your REST superannuation because you became part of that membership, or CBUS because you are in that industry, or it may be that you took out a superannuation all those years ago and you just took whatever the employer gave you. You can obviously apply for more insurance, so you can personally have a policy yourself, or you could ask your current provider to increase that. And that's when they'd be saying, can we have some more medical information before we make that decision? And therefore, if you ask for more, they did a medical assessment, they might then say, we're going to decline that policy for these reasons, or we're going to put an exclusion or an exemption, but they will never take away the policy that's already in place. So long as those premiums are being paid for, you'll always have that, whereas the top-up may have some alterations, exclusions, or it may be declined for medical reasons. Yeah.
I guess that really emphasises the point of not cancelling any super policy to really sweep them up. Yeah, I had a question then it's gone out of my head just as quick as it came in. I might think of it again.
So I have been successful, and this is probably a really unique. I've done some work for Cancer Council in WA, and we had a client who was diagnosed with obviously a terminal cancer. I had a look at superannuations. The policy had cancelled, unfortunately. I then went to the provider to try and reinstate it, and I was able to reinstate it, and we were able to get it backdated, and then we went to claim, and the claim was paid out. So, you know, it's kind of the tricks of the trade that you kind of know how you can, I don't really want to use the word circumvent it, but you can actually go back in time to try and rebuild what you had in place. And therefore, that's what we're able to do in that particular client's outcome. And it was a great financial outcome for them.
That sounds really positive. I know in the community in the Mito community, there's talk about genetic discrimination when applying for different insurances. I'm not sure where we're up to with that, but if we are declined for a new policy, or if we've tried to apply for something else to reduce premiums, and that declines us, that's not going to affect the existing policies we have, is it?
No, that's correct. So what happens with existing policies is that they took on the risk at that point in time, and therefore that's just how insurances are worked. It's just around the risk or the likelihood of claim. But then obviously if you've subsequently found that you have something that is more significant, they can't cancel the other policy. Yeah.
And when we're talking about all these insurances that come with super, so how I know that when I have a policy, but I didn't know I was ever paying for all these insurances. It was being paid for out of my super fund. Is that the norm, or is there any instances when I would have to pay out of my money that I've earned and in my bank account to pay for these insurances?
Yeah, so superannuation is just a really simple way, because obviously the employer's got money going in. Your superannuation is generally earning more than some of the insurance premiums, and it's just a really easy way that you don't have to sort of think about it, and it kind of is a very good set and forget. The superannuation fund claims those insurance policies as a tax deduction internally within the fund. So I don't want to get too complicated, but it's just a nice clean way of actually having it. Whereas the trauma cover is a personal payment that would have to come out of your personal bank account, can't be structured in superannuation, can't be claimed as a tax deduction. So that's the trauma being the one-off lump sum. With income protection, you can have part in super and part outside of superannuation. If you own it yourself, income protection is a tax deduction. So I guess that's a helpful thing for claiming that back at the end of the financial year. So as you can see, there's death, TPD, and super is the best place for it. Trauma, personally paid, and income protection can be a hybrid of the two. I prefer someone to personally own it myself. Yeah.
And so then obviously we've just mentioned lots of insurance policies and lots of confusing talk for the average person like me. And so we have our super, and then the insurances to that are separate. So we can have income protection, we can have death insurance, we can have total permanent disability, and we can have trauma insurance. So there's 4 different policies. Is that right?
Yes, that's right. Yeah. And you'll see inside a member super statement, if you have the insurance cover, because they'll disclose it at the end of the year, and how much the premiums are for that death and TPD cover.
Yeah. And I don't think you're able to answer this. I think it's very personal, but are we looking at like thousands to every month to pay for these insurances, or is it more, in the hundreds kind of thing? And when having a medical condition like Mito is really expensive to pay for just your GP every month, that
Yes.
how much am I going to need to have to pay for all this?
Yes, great question. So obviously, when the insurance companies look at an individual person, they're looking at them from a risk point of view. So how old is that person? Are they male or female? Have they had any pre-existing injuries, accidents, or illnesses? And how much level of cover are they actually applying for? So as you can imagine, if someone is a smoker versus a non-smoker, so they're looking at sort of statistics, characteristics of that person to say, you're Joe average, so therefore your premium's X. You're high risk because of all these other factors. You jump out of airplanes and you have motorbikes and etc. So they do a risk assessment to say, we will not give you the standard cover premium. We're going to actually put a loading on top of that because of the risk factor, or they'll remove all of the high risk areas altogether. So if you've had 3 knee reconstructions because of your basketball history, they'll remove your right knee, as an example, from any other future injuries because it's highly likely that you'll injure your right knee again. When it comes to the premium, so it'll be male, female, age specific, how much cover you've got in place, and then all those little intricacies, whether you're wanting to have what they call the buyback, as I spoke about in trauma. So if you had one claim and you wanted to claim again, you have to, there's a policy there. I can't just say it's just one size fits all.
I think that really summarizes it. I think like that, it shows the complexities of like, it really is very individual.
Yes.
Answered it, nailed it.
Yes.
When we were talking about all the different insurances and we were saying that the super pays for some, can any of the insurances just be purchased as a standalone, or do they have to come under your super?
No, you can have them all standalone. It's just from a death and total permanent disablement, it's easier for the super fund to pay it because you don't think about it. It's in the super fund. Obviously, it's taking away a little bit of the value for your retirement. You can certainly own a policy yourself. So, for example, Laura, you could take out a life insurance policy on me. So if I passed away, you'll be the beneficiary of that life policy. So you don't necessarily take a policy out on yourself. It's also who's the owner of that policy. So in that case, Laura, if I passed away, you're the owner of the policy, you'll be the beneficiary of that policy, and that would be outside of superannuation. Inside superannuation, it's really important to have the nomination of the beneficiary on the super fund. So therefore, that nomination of that beneficiary will then guarantee to receive that superannuation balance, death and TPD. Yeah.
Perfect. So moving on, so talking about so what income support programs, benefits, and potential tax deductions for medical expenses are available to somebody with chronic illness?
Yeah, I guess this is where depending if you've got a mortgage, it might be that you've got some cover through the bank that you took out the mortgage insurance with. So that might be something that needs to be addressed with your bank. It may be that you can have a grace period to postpone any interest components for a period of time, and that's something that you might negotiate with the bank if that's going to financially ease the burden, I guess, relatively short term. I also, WA Health, NDIS, obviously chronic illness is something that we have access to through the insurances. Obviously, the different health departments But those are kind of the ones off the top of my head. And obviously you've got the Centrelink as well. So technically, I was looking at chronic illness and a definition for Centrelink, and it comes underneath the Centrelink sort of disability services. So there's some linkage there for people who have a chronic illness to go down that particular path. Yeah.
Perfect. And so for the likes of somebody who's been diagnosed with a chronic illness a lot younger and they've not reached working age, will they be entitled to Centrelink benefits? And would they be able to get any insurances that we were discussing earlier?
Yeah, good question. Yeah, so generally, insurance and superannuation kick in at 18 years of age. That's typically when most people start to make some employment. There are superannuation funds out there that will give you an automatic acceptance because they have hundreds of thousands of people in there. So you're not necessarily having to go through the medical application. So if you were to work for Hungry Jack's and you needed a superannuation and you took out the Hungry Jack's industry fund, it's highly likely that you'll get some of that automatic acceptance cover in there. And what you want to try and do is obviously take out the maximum because they're not going to be asking any medical questions at that point of time. So you can apply quite early to get some access, but generally it's 18 years of age. Typically, the sort of the adult can make the decision to actually apply and so on and so forth. Yeah.
And when we were saying before about there needs to be money within that super fund, can I'm not sure if you'd be able to answer this, but can payments be made into the super fund to cover those insurances? So could a parent pay into their child's fund?
Absolutely correct. And that's what I would encourage to say, if your superannuation fund balance is starting to drop, let's put an extra $1,000 or $2,000 in just to make sure that we've got enough premium for the next year or two, because the last thing we want is to actually lose that cover because the balance of the super fund is dropped below, and it may be that they stop paying the premium for that death and TPD inside there. Absolutely right. So I can make a payment into your superannuation fund to help make that cover. It may be that you choose to claim as a tax deduction or just put it in. There are legislative restrictions, but to answer the question simply, Laura, is yes, you can make some additional contributions to keep the insurances that are in place. Yeah.
And I have no problem if you'd like to pay into my super fund, that's completely okay.
So long as you put me as the beneficiary,
So why should a person consider setting up a financial power of attorney or guardianship for themselves?
Yeah, so a power of attorney really gives someone else the authority to act on your behalf when it becomes making sort of financial decisions. There are different layers of power of attorney. So the one that's, I guess, the most powerful is what they call as an enduring power of attorney. That's where someone can actually sell the house if need be. The reason that it's enduring is because it will then be stamped on the title of that house, goes to the stamp duty office, DOLA, and therefore you are technically entitled to sell that house. So that would be if you had needed someone to sort of act on your behalf to make some really big financial decisions. I encourage my clients to get power of attorneys, particularly if they're going overseas for any length of time, because I can't do anything if they're outside of Australia. So therefore I'll ask their son or their daughter to be able to act on their behalf in order to sign off on a legal document for me to move money or make a decision for them. A power of attorney is also helpful for the banks in order for you to get online access to their banking facilities. So therefore it just relieves the complexity of having to make a decision, but someone else can actually do that on my behalf. Yeah. So that's
how would I apply, or how would I nominate somebody to be is it something that I can do online, or?
Yeah, so I would generally suggest that when you meet with a lawyer would normally be doing the power of attorney. It's pretty complex if you try and do it yourself. Normally you'd do the will at that point of time, and then part of the will you then say, oh, can I actually have a power of attorney? They will then talk through actually what level of power of attorney you're needing to look for. And they may even talk about other sort of health benefits around the guardianship and decision making if you're unable to make a decision because you are unable to do that yourself. Yeah.
Perfect, thank you. So why is proactive planning essential for managing finances while living with a chronic illness?
I think as I mentioned, the very early fireside conversation is around really just removing one less stress. If your financial affairs are in order, if you know what's going on, if you know that you're going to be successful in a claim, if you know that your superannuations are all nicely bundled up together and you've got the best possible position to be putting yourself into, it's just one less complexity that you have to deal with. There's enough spinning plates that we have to deal with as it is, let alone having to make sure that your finances, if they're in a complete mess, that's just a stress, I think, straight away. Costs savings, it may be that we collect the superannuations together after we've done some research, choose one fund, because as you can imagine, if you've got multiple funds, there's multiple fees that's being paid. So you might say, well, I'm going to keep policy A because that's where my insurance is, but these other policies are pretty small, they don't have any insurances. Well, let's make the decision to roll those across into here, and therefore we've got a slightly bigger balance, we can cover off the insurances, and that probably a really helpful way of doing things. I think education is really important. The more you know, the more you understand, the more information you've got, the easier it is to make a decision. That's half the battle with some people is, this is all too complicated, it's just overwhelming. If you get some education, understanding, talk to someone who's able to express it in a very simple form, you can say, yeah, I get it now. There's an aha moment, I can make a decision, and therefore we can proceed with that. So those are kind of the notes I had around that sort of, yeah.
Leading on from that, then I guess, regarding kind of education and having those conversations between friends, what would you say are the most common misconceptions about like financial planning and things like that in general that you're aware of?
Yeah, so I guess barbecue talk is always very, most of my phone calls on a Monday morning are as a result of barbecue talk. So what I mean by that is they phone me up and say, Calum, I was at this barbecue on the weekend and such is doing something. Why am I not doing that? And I can then confidently say, well, the reason you're not doing that is for these reasons. And that kind of puts their mind at ease. When it comes to putting together I guess the financial aspects of it, it's just much simpler when it comes to tidying up the financial affairs, and it also helps just with reduction of fees and so on and so forth. I probably haven't quite answered that question. Did you want to maybe ask it in a slightly different way?
No, I think that we've definitely covered different misconceptions, and like one that really stands out for me is not leaving this event and then closing all my super funds. I'm definitely going to be keeping them all open and getting some individual financial advice to make those decisions and find out what super and insurances I actually have, because I wouldn't have a clue. So I'll speak to somebody who would.
And in most cases, an advisor is likely to have an initial meeting at no cost to the client in order to know whether or not they're able to help or aid with advice. If they say, I can't help you, there's a genuine reason behind they can't, because they don't want to change the super fund. It's inexpensive. You've got it in place, and just leave it, which I guess is advice in itself. In other cases, if they do need to charge a fee, or there's got to be a cost associated with research, implementation, technical advice, a lot of that can be paid for from superannuation funds already in place. So it may be that there's a fee that needs to be agreed upon for the future of that advice piece, but a lot of that advice might be around the superannuation or the insurances and the superannuation And therefore the super fund has an obligation to say, well, it is related to retirement, it's related to the well-being of that member, and therefore that policy can actually be charged out, and therefore that fee can be charged out of the superannuation fund and not necessarily fully from that individual's pocket. So there's just that different ways that we can actually use the super fund for those payments. Yeah, there's no more big, huge commissions that are paid anymore. There's no costs associated with transferring supers between one and the other. It's very simple to do through MyGov. It's really just that initial advice piece. Mostly it's the intellectual property and research that we need to do in order to act in our client's best interest to deliver that outcome. Yeah.
Thank you. So there's just a few questions that have been submitted. So one is it better to have a self-managed super fund to access monies easier for medical financial stress?
So the answer to that is depends. The reason being is that a self-managed super fund is still governed by the overarching legislative requirements. So whether it's a REST super fund or an industry super fund or a BT Panorama or MLC, all these, personal policies or even a corporate policy at work, a self-managed super fund still has to be governed by all of those rules and regulations. So you can't just sort of tap your self-managed super fund to pay yourself, because at the end of the year, that self-managed super fund will have an annual return. It will have a statement, the same as all the other funds, but it will also be audited. And it's the auditor that will then say, you have breached SIS, Superannuation Act. You took the money out without any real purpose. You've used it wrongly, and therefore that super fund has to be reported, and therefore it'll probably end in tears. So hopefully that's answered that one.
Yeah. Thank you so much, Calum. It's been really great conversation. How you can contact Calum to gain some more information, or if you've got some more questions, they are on the screen now. And I'll just run through some resources that we have on our website. I will pop these into the chat in the next minute or so, but we have information about different government support, government payment, and different concessions that are available in each state on the Mito Foundation website. Thank you so much for everybody joining. Thank you very much, Calum, for all your expertise and knowledge. It's been a great conversation. I've definitely learned a lot from you. And I guess my biggest takeaway is definitely to go and explore what super funds I actually have floating around, what insurances I might be entitled to, and then exploring and getting some personal advice, whether I can access any of my insurance policies if I am not able to work anymore, or whether I have a trauma policy that may be able to pay out for mitochondrial disease. If anybody has any questions about this, you can contact Calum directly. He is happy to take phone calls, and he will be able to put you in touch with advisors all around the country. Is that correct now, Calum?
Yes, that's right.
Perfect. Once again, thank you so much, and it's been an absolute pleasure. Thank you.